Lower oil prices, easier financial conditions, but still hawkish central banks and fragile geopolitics are pulling today's cross-asset picture in different directions. Allocators are having to judge whether this relief rally marks the start of a new Goldilocks phase or just a pause before the next shock. Welcome to vTalkInsight, Allocators Lens Daily for June 16, 2026. Let's look at what equities, rates, credit, foreign exchange, and commodities are signaling right now. In equities, the dominant tone is relief as geopolitical de-escalation around the United States and Iran sends oil to 3-month lows and unlocks a broad risk on move. Asian indices are rallying hard, with technology and semiconductor names leading, while European benchmarks have broken to new highs as lower energy costs support manufacturing-heavy markets. Under the surface, leadership is rotating toward parts of the market that have been under pressure from high energy prices. Airlines are bouncing on lower fuel costs, even if industry experts flag that capacity and pricing will only normalize gradually. European consumer cyclicals, automakers, chemicals, and financials are also outperforming as expectations build for sustained relief on input costs and a more growth-friendly policy stance out of Brussels. This equity strength is backed by robust fundamentals. S&P 500 earnings are near historical highs. Consensus points to strong double-digit growth over coming quarters, and much of the recent index gain has come from earnings rather than multiple expansion. AI-related stocks now make up around half of the S&P, supported by massive planned hyperscale capital expenditure and a view that semiconductors and memory have become structurally less cyclical. That said, this creates concentration risk if the AI narrative stumbles. At the same time, the equity market is shifting from an era dominated by buybacks to one of heavy issuance. Recent deals, such as the SpaceX listing, have traded well, and estimates suggest that hundreds of billions, if not more, of IPOs and secondaries could hit public markets over the next couple of years. Successful, low free float deals with index inclusion potential can attract passive flows and support regional indices, particularly in Europe, but they also test how much primary supply the market can absorb now that corporate buybacks, especially from hyperscalers, have slowed. Balancing that optimism are two clear equity risks. First, AI regulation is moving from theory to practice. The United States has forced Anthropic to restrict access to advanced models for foreign users, and broader export controls on frontier AI systems raise questions over the durability of today's AI-driven rally. Second, the U.S.-Iran framework is still fragile. Israel has pushed back publicly. Shippers are waiting for hard guarantees before fully rerouting through the Strait of Hormuz, and any reversal could hit the newly resurgent cyclicals hardest. With equal weight indices and small caps now making new highs, the equity story increasingly depends on rates staying calm, which takes us straight to the bond market. Rates markets have welcomed the drop in oil and the prospect of reduced Middle East risk with a classic relief rally. Yields in both the United States and the United Kingdom are lower, and the curve now prices only a fraction of the additional tightening that had been expected by year-end. In the euro area, talk of further European central bank hikes has cooled somewhat, even as President Lagarde keeps a hawkish tone around wage dynamics and second-round effects. Despite that repricing, the message from the Federal Reserve remains a hawkish hold. Strong U.S. activity data, a still tight labor market, and sticky core inflation are all seen as reasons to keep rates on hold for now, with the door open to further hikes later in the year. Markets expect the Fed to remove its easing bias rather than pivot to cuts, and there is a recognized risk that the new chair could hold rates high for longer and dial back forward guidance, which would raise rates volatility from today's calm levels. That helps explain why longer-dated Treasury yields have not fallen as far as the move in oil might suggest. Persistent U.S. fiscal deficits, heavy upcoming Treasury and corporate issuance, and uncertainty around how fast inflation can return a target are all keeping term premia from collapsing. There is also an acknowledgement that the Fed's balance sheet is unlikely to shrink dramatically from here, with normalization focused on shifting mortgage securities into treasuries rather than shrinking total assets. For allocators, the near-term picture is one of gentle support from rates for risk assets, but with clear ceilings. A sharper inflation surprise, renewed stress in energy markets, or a more aggressive tone from the Fed or ECB could all see the front end reprice higher again. Conversely, if the Iran deal holds, oil stabilizes at lower levels, and wage and shelter inflation keep moderating, the current higher for longer but not higher forever stance could stay in place, which has direct implications for credit. Credit markets are, for now, enjoying the same Goldilocks mix that is helping equities. Falling yields, talk of central bank pauses, and resilient growth have kept spreads contained, with particular support for borrowers tied to AI infrastructure and other capex-heavy projects. Lower oil prices also reduce near-term concerns about energy-driven defaults, and the risk-on tone after the U.S.-Iran framework has encouraged investors to look again at previously pressured sectors. Beneath that calm, though, stress indicators are edging higher. Defaults are rising from very low levels, and there are signs of turbulence below the investment-grade surface, even as headline spreads look benign. The funding demands are significant. Large AI projects, a powerful IPO and secondary calendar, and widening government deficits are all competing for capital, while overall liquidity conditions are tighter than last year's peak. This leaves credit in a sweet spot that could prove fragile. Income and value-style exposures, where companies are generating and distributing cash, appear better aligned with an environment of modest growth and constrained liquidity than highly leveraged, story-driven issuers. For portfolio construction, the key questions are how much more spread compression is realistic and how quickly credit could reprice if either rates volatility spikes or the AI-led equity complex experiences a more serious drawdown. In foreign exchange, the immediate story is a softer U.S. dollar. As oil prices drop and global risk appetite improves on the U.S.-Iran ceasefire framework, the dollar is weakened against most major developed currencies, giving a lift to emerging market foreign exchange. That weaker dollar backdrop is consistent with the global relief rally in equities and credit, and it eases pressure on energy importing economies for now. Within G10, divergences are emerging. The euro is supported by expectations of at least one more ECB hike, although fragile eurozone growth limits the scope for sustained appreciation. Sterling's downside looks more constrained in the near term because positioning is heavily short, so even political noise may not move the currency much without a real policy surprise. In Asia, several emerging markets, including Indonesia and Korea, have already raised rates or intervened to contain currency volatility, and Korea in particular is seeing equity strength alongside pressure on the won as investors hedge gains. Looking a bit further out, the case for a structurally weaker dollar is less clear. Persistent U.S. fiscal, spending, and lingering inflation risks are seen as reasons why the Fed may have to keep policy relatively tight compared with peers, which could support the dollar over the medium term. That tension between a short-term, risk-on-driven weaker dollar and potential longer-term support from relative growth and yields will be an important cross-asset signal, especially for emerging market debt and equity allocations. Commodities remain at the heart of today's macro story. Crude prices have fallen more than 4%, to their lowest level in about 3 months, as markets anticipate that an interim U.S.-Iran deal will reopen the Strait of Hormuz and normalize oil flows. That drop removes some of the immediate stagflation risk that had worried central banks, but it does not mean energy is suddenly risk-free. There are still important supply constraints. Shipping firms are cautious, waiting for concrete guarantees and insurance before fully restoring traffic through the strait. And damage to key infrastructure, such as Qatar's Ras Laffan LNG facilities, will take years to repair. At the same time, Ukraine's energy system remains under regular attack, even as it integrates more closely with Europe's grid. These structural vulnerabilities help explain why crude remains anchored around $80 despite the recent slide. Elsewhere in the complex, gold and silver are rallying, both up several percent, reflecting a combination of lower yield expectations and continued demand for safe havens amid geopolitical and fiscal uncertainty. Critical minerals are also back in focus. China's strict export controls on scandium have highlighted supply risk, driving strong gains in related mining equities and encouraging new projects and downstream investments aimed at securing materials for advanced electronics and AI infrastructure. That reinforces the idea that even in a risk-on-tape, commodity and resource security are long-term themes for asset allocators. Stepping back, today's cross-asset picture looks like a fragile Goldilocks. Equities, especially in Asia and Europe, are riding a wave of earnings strength, lower oil prices, and a powerful primary issuance calendar. Rates markets are offering just enough relief to support risk assets, but higher for longer remains the central bank baseline, and supply, as well as inflation uncertainty, keep a floor under yields. Credit sits in the middle, with spreads still tight, but default and liquidity risks edging higher beneath the surface. In foreign exchange, a softer dollar and improved risk appetite are giving emerging markets some breathing room. Yet medium-term support for the dollar from U.S. fiscal and inflation dynamics cannot be ignored. Commodities round out the picture. Crude is off the highs, but structural energy security issues, a bid for gold, and the scramble for critical minerals all argue against complacency. For allocators, the key things to watch now are the final shape and enforcement of the U.S.-Iran deal, the upcoming central bank decisions, the behavior of AI-related regulation and earnings, and how markets digest the heavy IPO and issuance pipeline across regions. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.